You're listening to Choose FI Radio. The blueprint for financial independence lives here. If you're looking to unlock the secrets to financial independence and early retirement, you're in the right place. Stay tuned and join a community of like-minded people who are getting off the hamster wheel and taking control of their lives in the pursuit of financial independence. Choose FI, your home for financial independence online.
All right, guys. Well, today we're very excited to get a chance to tackle this episode. We've been promising that we were going to bring on a true expert to help us tackle this idea of implementing a drawdown strategy. And this is one of those advanced techniques that you have to cover the basics before you can get to this. You don't just start with drawdown strategy. You talk about investing strategy. You talk about risk tolerance. You talk about what is your ultimate goal? Where are you heading? Where do you want to end up? But once you've covered the baselines, including things like sequence of returns, now you're ready to start talking about how do you implement your drawdown strategy. And in our minds, there was no one better to help us tackle this somewhat complicated topic than Fritz from Retirement Manifesto.
Yeah, this is an episode I've been looking forward to for a while. I frankly know just about nothing on the optimal drawdown strategy or even the different options. So for me, this is going to be a learning experience for sure. And like you said, Fritz is the perfect person to speak to. So yeah, this should be a really great episode for not only learning ourselves, but for the audience. So yeah, it's good stuff.
And to our show for the first time, Fritz from Retirement Manifesto. How are you doing today, Fritz?
Hey, Jonathan, Brad. I'm doing great. I appreciate you guys having me on your awesome podcast. You guys are crushing it, and I'm honored to be on your show. So thank you very much for the opportunity.
Well, the honor really is ours. We're very excited to have you. You're very highly regarded both in the personal finance sphere, but also in our own FI community. And there's plenty of overlap between your audience and ours. But I think the nature of your focus, which my understanding is you typically focus more on that 40 to 60-year-old population, there's so much information to glean, and we really get to benefit from all the time and research that you've put into this particular subset of our population.
Well, thanks. And, there is a huge overlap. I mean, I've looked at a couple case studies where people hadn't started saving early enough. They were maybe in their late 40s, early 50s. And guess what? They can use the FI principles and they can retire, by age 60 or whatever. That 15-year window you need to reach FI, even if you start at 40, okay, you can still retire at 55, right? So the principles are very much the same. The difference is, I think, as you said, my audience tends to be a little bit older, and I spend more time thinking about what's life about post-retirement. I focus as much on the post-retirement life as I do on getting yourself to the retirement stage. So that's a little bit of the difference, but a huge overlap, I agree. So there's a lot of parallels.
And Fritz, when you said I focus on what life is about post-retirement, are you talking, just to explain to the audience, like, is your blog generally about the nuts and bolts of the numbers, or do you delve into what life actually looks like post-retirement?
Yeah, that's a good question. And it's kind of evolved. I've been writing about 2.5 years now. And when I started, it was really financially focused. Here's how you should do your asset allocation. Here's how you should, calculate if you have enough to retire. It was really focused on the financials. But as I've done more and more research and written more and more posts, and obviously you pay attention to this stuff because it's kind of my space right now, I'm finding a lot of information that it's the softer side of retirement that can make or break it, and a lot of people focus on the financials, and then they hit the starting line, as I call it, not the finishing line, but the starting line of retirement, and suddenly they don't really enjoy retirement. They kind of fail at retirement. And what I've found is a lot of these softer issues about what are you going to do with your time? What are you going to have as a purpose? You've been working for a long time. You've always had the man telling you what to do. Now you've got to design your own life. And most people underestimate the amount of time and effort that they should put into that side of retirement planning. So that's the type of content that I've been putting quite a bit of effort into. And a lot of it's because personally, I'm only 9 months away from retirement myself. So it's stuff that I'm thinking about.
I think it's a little bit ironic that it is the total opposite of what our focus is going to be, which is absolutely the nuts and bolts of drawing down on your asset accumulation phase.
Yeah, it's funny. You've got to have both, no doubt about it. It's easier in a way to talk about the financial side. And on the drawdown specifically, I'm really glad that you guys want to talk about that today because you guys see a lot of the stuff in the FI community. It's all about building wealth, building wealth, building wealth. How soon can you get there? Well, we put all this effort into the accumulation phase, but there's surprisingly little content on the decumulation phase, and it's equally important, arguably more so, because if you mess it up, you run out of money, and what are you going to do? So it really is a good topic that I think's been undercovered, and I think it's an awesome topic for your audience.
I love that you're having that somewhat light bulb moment with us here, because I noticed that on your blog, even though you've been writing for the last several years, it wasn't until very recently that you actually took the time to apply all these tools that you've been building and developing and actually apply it towards developing your own drawdown strategy.
Yeah, that's right. And, I kind of had ideas in my head, and I kind of knew what we were going to do, but there's something about putting it into words and having to create a flow and have it make sense and have logic to it. And it really helped me to kind of cement this thing down. And as a matter of fact, what we did is I thought the concept was so underreported that we actually started a blogging chain, and there's 25 bloggers who have written their own drawdown strategies, and we're all linked together. So anybody that has an interest can just click into my article, and you can read 20 other articles of what other people are doing to manage their drawdown strategy. So it really is helpful to put it into writing.
Yeah, and we'll definitely link to that in the show notes so everybody can find that chain there, certainly. Fritz, you said you're 9 months away from actually putting this into place in your own life. Tell us a little bit about your story generally. Obviously, I guess you're 9 months away from pulling the retirement trigger. I'm not sure how early or not early it may be, but that's largely irrelevant. You're going to need these drawdown strategies in the next year. Just give us a back on your story and your path to today.
Yeah, absolutely. Thanks for that. I'm 32 years. I'll be 33 years in corporate America. Started right out of college, and I've had a good job with a good career, good corporation. I've stayed with one company the whole time, which is very unusual, but they've been good to me. And I've had a lot of different jobs. I was plant manager. I ran North American supply chain. I've done a lot of different things. Now I'm a commodity trader. So I've had a lot of different experiences, and through it all, we've been diligently saving, and we'll be getting out at age 55. So it's not as early as a lot of the FI community, but it's still pretty early when you look at the average population. So yeah, next summer I'll be 55, and the plan at this point is to pull the trigger. I haven't officially announced it at work yet, but a lot of people know what's going on. So, we're looking at by next summer, loading up a fifth wheel and spending some time camping and enjoying life.
I think what's so interesting about that is before the surge in the FI community, to retire at 55 seemed like an act of rebellion against societal norms. I'm sure at some point you remember thinking, I'm the rebel here, right?
Yeah, it's funny because in the FI community, I'm kind of the odd man out. Everybody in the FI community, you look at Steve over at Think Save Retire, he's out at 35. You get a lot of people that are out in their 30s, maybe early 40s. They look at 55 as kind of, he's kind of a late early retiree. But when you talk to the population at large, yeah, the reaction that you talked about is exactly the reaction. How are you getting out so early, right? It's funny, the difference in perspective of what a retirement at age 55 is, depending on which audience you're talking to. So it is an interesting dichotomy between the way that the FI community thinks and the way that the society as a whole thinks. And it's interesting to watch that.
And then obviously the next tangent to tie to that is the difference in perspectives on what a good savings rate is between your normal American society or normal, global society versus how we view it both in your community and in our community.
Absolutely. I mean, you guys know the numbers. You look at stuff, they're saying the average population savings rate is less than 5%, and I would argue I don't know what the average is in the FI community, but probably well north of 25%, so it's a 5x, 500x multiplier that in the difference. And it's huge. The impact that has on over, a decade or so of savings, the wealth that you create by having that higher savings rate is just unbelievable. So yeah, it's a huge difference.
Fritz, have you received any kind of blowback or pushback from any of your friends or family for retiring early at 55? Because to many of these people, that does seem radical. Has that occurred in your life? Or do people know that you're a saver and you have all your ducks in a row?
Yeah, I really haven't gotten much blowback. I've got quite a few friends that have retired in their mid-50s. My family's been very supportive of it. They're excited for us and happy for us. And, my wife's family's the same way. So nobody's, they may have some thoughts internally, but they don't voice them to us. And they appear any interactions we've had with friends, family, both sides, all around, it's been nothing but supportive. So it's been really encouraging for us.
Yeah, that's great. That's certainly great. And I guess my question, this might be kind of an abstract question, but had you found the FI community, let's say 20 years ago, do you think that you would have retired before 55 based on your current savings rate or your savings rate over your career, et cetera? Like, do you look back and say, I could have done X, Y, and Z different, or would this have been your path almost regardless?
Yeah, that's a good question. I mean, we've always been diligent savers, and we started right out of the chute saving pretty aggressively. But at the same time, we've also wanted to balance that and enjoy today, right? So we've always taken nice vacations. My daughter's 22 now, but when she was at home with us, fortunately, I get a lot of frequent flyer miles, so we'd always take big vacations. We've been all over the world together, and those are priceless memories to me. So even if I had been aware of the aggressively FI type environment, I still think we would have chosen the balanced approach, which, we're getting out a little bit early, but we had a heck of a lot of fun along the way. And to me, that's, you got to live every day. You can't put everything off for tomorrow just to get to that FI date. We're only here once. You gotta enjoy life as you live it. And we've had a pretty good balance. And I think I probably would have done the same thing.
Yeah, that's a very important point to live life and balance. I certainly agree with that. And I'm curious. So you've been with the same company for 32 years. Is that what you said?
Yeah. Is that insane or what? The last of the dinosaurs. And I never intended it when I started. They were interviewing on my college campus. I went as a practice interview, really. And 32 years later, I'm still with them. I never really had a reason to leave. I had a couple of offers, and I've just always been content. And fortunately, I still have the traditional pension. So, that was a tremendous benefit to be 3 decades plus in a company that still had the pension. They've discontinued it now, but I'm grandfathered in. What a huge blessing to have that, as we're right on the cusp of retirement. That's what's getting us out a little bit earlier than most people do. So it was a huge help.
Yeah, I can imagine. And that was my very next question was, do you have any of the vestiges of the old corporate America, like retirement, pensions, and healthcare, and obviously of the pension? But is there anything else that I guess you're fortunate enough to be grandfathered into?
That's pretty much it. They killed the health insurance probably 5 years ago. And, I was starting to map out our plans for early retirement then. And I remember the very first retirement cash flow spreadsheet I did years ago, I whacked the health insurance. Even back then, my assumption was it would never be around. And sure enough, they killed it. So I'm going to have to go in the private market for insurance for, 10 years until we can get Medicare or Medicaid. So we've got a 10-year bridge. Hey, it's unfortunate, but you build it into your numbers. And when your numbers say you can go, we go. That's the biggest benefit is the pension.
So what I heard in there also was your retirement drawdown spreadsheets that you evidently have been doing for quite some time. Like, how do you get into having that as an interest? Like, where did the website come from? Where did your interest in the real technical analysis of this come from?
Yeah, that's a good question. I mean, I think back to when I was in my, late 20s, I started tracking my net worth. I've always been I call myself a passionate financial planning hobbyist, right? I've always enjoyed this stuff. I've always read personal finance magazines, articles way before it was in vogue to do so. So I've always had an interest in it. I've always tracked numbers. And I would say it's accelerated with the launch of my blog, which mainly I launched that, to be honest. We talk about this life after retirement. What are you going to do to fill your time? Well, I was already having some of those thoughts 2.5 years ago when I started the blog. And my primary reason for starting it was to kind of just, hey, let's give it a flyer, see if it works. And if it does, maybe this is something that I can continue after I retire, and it's something that'll fill some of my time and give me a purpose. And it's done exactly that. So I think I really started it as a little bit of a trial run to develop a potential interest for post-retirement. And it's exploded into this, wonderful community that you guys are a part of. And we've all got so many friends now in the FI community. It's beyond my wildest dreams. It's fantastic.
We have a friend in common, Big Earn from Early Retirement Now. And,
yeah.
But I know one of the things that he mentioned as one of his primary motivators to start writing Early Retirement Now was to start documenting these ideas that he already had and coming up with a strategy for himself. And instead of just thinking about it, there's something to be said for the value of committing your thoughts to paper, not only for your own consumption, but for the public consumption as well. It allows you to refine your ideas and forces you to think about them critically.
Absolutely. And he's a mathematician wizard. That guy, I can't even come close to even understanding his spreadsheets, let alone creating them. He's really, really good. And he's right in that writing a blog, I write one article a week. So as you go through life, you're always looking for things that you could potentially develop into an idea for a blog. So, I've got 50 drafts that are just ideas, right? And what it does is it forces you to prioritize the areas that you want to address. And it really does help develop and formalize your personal plan at the same time helping others. My byline is helping people achieve a great retirement, because I think the steps that a lot of people in the community are taking can benefit people that aren't necessarily in the community, and the blog's the perfect way to reach them. So there's just win-win-win all the way around in this thing. But definitely putting it down in written word forces you to really get serious and solidify your plans, and a lot of people benefit from that.
creating a blog forces you to always be curious. And it also forces you to figure out what's a better question. Life gets more interesting when you realize that it's a series of questions that you're trying to figure out how to ask.
Absolutely spot on. And I think one of the things that I've realized, I've always been a lifelong learner, but one of the things that I really think makes life enjoyable is having that type of mind that's always seeking to learn and grow and question things. And the blogging or even podcasting community is a perfect venue to kind of fertilize that type of mind, and it's a good asset to have. And for those that don't naturally have that attribute, really spend some time and try to develop it. The fact that they're listening to your podcast, most of your audience probably have that attribute. But if you don't, really try to stir up that curiosity, and it makes life more fun. It adds a lot of spice to life.
So Fritz, let's go ahead and hop right into the main topic for today's conversation, which is this concept of a drawdown strategy. And I think maybe before we really dive into the specifics of your strategy, we should just talk generally about why it's important to have one and what to consider when developing your own personal drawdown strategy.
Yeah, that's the right place to start. Just conceptually, if you think about it, you've spent 20, 30 years, whatever it is, building this pile of resources. And you've got to step back and say, okay, now I've got this pile of resources. You have to identify exactly what that pile is. And then within that pile, there's certain logic for sequences that you want to pull income out of that investment portfolio. So you need to sequence what are you going to pull out when and why, and how do you structure your asset allocation to minimize your risk of having a terrible bear market and suddenly your portfolio is cut in half, but you still have to draw money out of it. Sequence of return risk, it's called. There's just some basic elements that you have to be strategic on how you pull this money out to make sure that it lasts the rest of your lifetime. And that's really what it's all about.
And I would imagine that one of the things about this is some people may end up having very simple strategies because they only have one or two buckets that they're pulling from. Other people are going to have extraordinarily complex situations that they're going to be trying to extract themselves from. Maybe they were a little bit more adventurous in their pre-fi days and they got into a bunch of complicated investment strategies. Maybe they were in some high fee funds. Maybe they were spread all over the map because they have 401ks left with several different providers in their past and they never rolled it over. And so depending on where you are in this life when you decide to start tackling your drawdown strategy and whether or not you've begun the process of simplification first, this concept can have wildly varying degrees of complexity.
Exactly. And I think within that, yes, you're right. The complex portfolios are more difficult. And as much as you're able, and I understand people have different 401ks, they've got different stuff, that you got to deal with what you've got to deal with. But where possible, simplifying your portfolio in the last 5 years or so that you're working definitely makes your drawdown strategy simpler. And actually, as I get into some of the early phases of drawdown, I didn't put this in my article, but the other part I'm thinking about is where I've got these kind of one-off accounts where you got 50 grand over there doing something and, these little pieces around. My plan is to kind of pull those out early and continue to simplify as I move through the drawdown. So I think J.L. Collins says it best, right? The simple path to wealth. There's something to that. You don't have to make it any more complicated than you have to make it. But at the same time, you got to deal with what you've got. So there's a balance there.
Now, I almost want to take that to the next step, which is simplify your life just in general. Don't necessarily wait to the last 5 years, but certainly within the last 5 years, you need to be considering how can I take all of this randomness and structure it? And if some of those vehicles aren't adding value or if they're adding extra complexity, maybe I consider burning through those first.
Correct. And I'll tell you another tool that worked really well for me. As part of the drawdown strategy, there's a bucket strategy. I've got some separate posts on that, but I'm using a 3-bucket strategy. So bucket 1 is, the next 3 to 5 years, got to be liquid. You don't want it to get hit with a stock market downturn. The middle bucket is kind of intermediate, 5 to 10 years. You want some growth, but still fairly conservative. And then 10 years out is stocks, right? Or equities. So what I've done, which really helped me clarify where all the different holdings kind of fit, is on my net worth statement, I just linked every single line, every single investment that we have into one of those buckets. So whenever I update the net worth, boom, my buckets are updated. And you can see, here's what I'm considering my holdings in bucket 1. And as you go through the drawdown strategy, as you have to refill those buckets, it helps you identify, well, there's something in bucket 2. Hey, it's doing pretty well right now. I'm going to go ahead and sell a year's worth of living expenses out of that bucket and move it into cash in bucket 1. So you have to have spreadsheets. You have to have, a structure, but linking them all together into these buckets really helps kind of visualize how the flow is going to happen as you get into retirement.
Fortunately, we can replace a lot of the spreadsheet math that you had to do back in the day with tools that a lot of us use, like personal capital these days. And there are ways to just rename some of those groupings of those accounts, and you could consolidate everything into one of those three strategies. And instead of figuring out what am I going to do with this specific fund, you just say, what am I going to do with this group? What's my strategy for this group? And it's less emotional because you're thinking of it in terms of general timelines.
That's right. And I'll tell you mentioned personal capital. I'm a big fan. We talked about complex portfolios. Even if you have a complex portfolio, with the tools that are out there today, personal capital specifically, but others like it, it can simplify a complex portfolio, right? Boom, here's your asset allocation. And I like your concept of trying to build an automated bucket strategy within personal capital. I've not thought of that, but I'm sure that's a viable approach.
Here we go. Choose FI making its contribution to the blockchain on a crowdsourced show. And since I did go ahead and bring that up, guys, let me go ahead and bring up a quick pitch here. If you have not yet set up a personal capital account, it's an app that you can download on your smartphone or tablet. But you can set up the account online. Just go to choosefi.com/P as in Paul, C as in cat. Great software, totally free. No reason not to do it today. That is an affiliate link, and you'll be supporting the show.
So, Fritz, I'm actually curious about the 5 years leading up to retirement that you mentioned a couple of minutes ago. So you talked about simplifying, and I love that. I'm totally on board. But presumably, people who have been saving for many years, and especially in taxable accounts, they have unrealized gains that if they sold different items, there would be taxable consequences. And also people are in presumably their highest earning years as well. So they'd be in a fairly significant marginal tax bracket. So I could be making a wrong assumption here when you're talking about simplifying, but like when I hear that, I hear, okay, take your individual stock that you've been dabbling in and sell them and buy VTSAX or whatever index fund or bond fund that you choose. But of course, there's a taxable event there. So again, I don't want to make an assumption, but talk me through what that simplification strategy looks like for someone and what they need to think about as far as taxable issues, different account, everything that you personally would consider.
You're absolutely spot on. And I really do avoid the tax hit. If there's a taxable event and big capital gains on something, okay, it's simple enough, right? You don't simplify at all costs. You simplify within what makes sense. Now, what I have done is if I've got a position that's got a material loss, I'll go ahead and sell that. Part of the simplification, right? It was a bad buy and it's just kind of drifting out there and we never want to sell the losers. We'll go ahead and sell the loser, do the tax harvesting and use that as an opportunity to sell something that's gained. And between the two, you just knocked off two outliers that you can then move into the more simplified strategy. So you can kind of, I would say, rifle shot it instead of hit it with a shotgun. You've got to be selective on how you do it, but just being aware of that principle of trying to simplify things. And I think it goes far beyond finances. One of the things we've done, which has worked out extremely well for us, we downsized out of our big city house. We moved up to our retirement cabin in the mountains. We got rid of 30 years worth of stuff in 24 hours on Craigslist. That's a separate post in itself. But we downsized, we simplified our lifestyle, we got into our retirement town before we actually retired. All those lifestyle simplification concepts apply as well as they do on the financial side.
You are preaching to the choir here, man. That is my perfect life, is really getting rid of all the junk, all the stuff that fills up my house. So yeah, that definitely resonated with me. I wanted to really point out something that you said a minute ago about using the rifle shot as opposed to the shotgun. So, and I want to make sure that the audience really hears this, is picking out the losers. So you're selling something and then you have that loss, and then you can offset it to essentially create a net neutral tax issue, right? So you're selling a gain, you're selling one that had gains, you're selling one that had losses, you're picking them out very specifically. And then that's a net neutral issue for your tax return. So I love that. That is really important. I hope people take that away.
Yeah, it helps to offset the gains with the losses. Obviously, you don't always have losses and you don't want to have losses, but let's be honest, you're going to have some positions in your portfolio that haven't done very well. So instead of making the excuse to continue to hold them like I have for years in some cases, go ahead and bite the bullet, take the loss and use it to offset the gain. It just makes sense. So that's kind of the strategy. And I think the other thing that fits into that is you've got to think about the tax issue on a broader question. A lot of people jump in and they do all the pre-tax savings through their employer automatically pulled. Well, if you have too much in pre-tax, man, when you get into retirement, number one, you can't access it till you're 59 and a half. So make sure you have enough after tax to bridge yourself to when you get your retirement monies. But you've also got a huge risk with the required minimum distributions, right? So what you should look at, and I'll just explain briefly what we're doing. And this is all about drawdown strategy. It's in the strategy. We're intentionally delaying my pension for 2 years after I retire to force my income down to zero. And we're going to take those 2 zero income years and we're going to do massive Roth conversions right up to the tax hurdle rate, right? We'll pull as much out of the before tax as we can to get us right up to that next tax hurdle rate, and we'll convert it all to a Roth. So we're intentionally eliminating my income to allow us to do this, and we'll live off our investments to get through that period because the tax savings are so huge to get that stuff out when you're at the lowest possible tax rate that you can set up for yourself.
And I know nothing about the mega backdoor Roth. I've read Mad Fientist's article 3 times. It literally doesn't make sense to me after hours of looking at it. So if you have a simpler way of distilling that, this would be the first time I'd be introduced on the show. It'd be really cool.
I've done a mega backdoor Roth for each of the last 3 years, and I'm a huge fan. So I can talk about that for a whole podcast if you want.
Yeah, I mean, that'd be great. I know you have this 2-year window of time where you're not going to be drawing W-2 income. You're going to be living off of your savings, and that's going to open up some unique opportunities for you to really capitalize on some of the advanced FI strategies that we've talked about. I would love to get your take on how you're going to approach this, both from a Roth conversion perspective, but also talk to us a little bit about that mega backdoor Roth, because we really haven't touched on that in this show to this point.
Okay, great question, and hard to answer in simple terms, but let's address them one by one. Let's talk about the mega backdoor first. And I'm doing that now. I've done probably 3 years worth of mega backdoors. And the way I'm doing it, I'm not necessarily using that as a tool in this 2-year window. I'm actually doing that now. And what I'm doing, I max out all the IRA stuff I can do, 401k at work. I max all that out. Above and beyond that, I contribute after-tax money into my 401k at work. So I've got an after-tax bucket in the 401k. And then twice a year, I can roll that from the after-tax into a Roth. The advantage of that is once it's in the Roth, it's tax-free. All the earnings, all the growth, there's never any more tax on it. If it stays in after-tax, it's just a normal after-tax. You get the capital gains hit, you get the dividend, the distributions, all those are taxed. If you can get that over to a Roth, guess what? It grows tax-free. So the mega backdoor, I need to write an article on that one. I've been putting it off because it is complicated, but there are some very good articles out on it. Basically, it's after-tax contributions into a 401k now, which is painful because I'm in a high tax bracket. But to me, having a diversified tax portfolio post-retirement is worth taking some tax hit now. So I'm intentionally taking the tax hit to increase the amount that I can put into a Roth through the mega backdoor, if that makes sense.
Perfect. And let me clarify just a couple points just for our listening audience. The maximum amount that you are allowed to contribute as an individual to your 401k is $18,000. But my understanding is above the $18,000, you can contribute up to a full limit, and this would be the difference, but up to $53,000 total. And that difference would be in after-tax dollars. Is that right?
That's exactly right. And I think there's a catch-up clause when you're over 50. It's another couple thousand. So basically, I'm pushing in like $50,000 a year. Let's use rough numbers. 20,000 of it's pre-tax, and then 30,000 of it's after-tax. And I do the mega backdoor with that 30,000.
So Fritz, everyone out in the audience who has never heard of this mega backdoor is saying, what is this, right? Like I thought the Roth IRA limits were $5,500 a year, and only certain people with certain incomes could put money in. So what the heck is this, frankly? Like, why are you allowed to put in, the difference between your $18,000 contribution to your employee deferral for your 401k and this $53,000 limit, so $35,000 a year, in what seems like a gimmicky way, right? Like, how on earth is this possible? And also, like, are there certain mechanisms you have to do? Does everyone's company allow this? Talk us through how this is even plausible.
And let me just say that as the host of the Choose FI podcast, I'm thinking that this is crazy.
Well, and I do think personally that loophole is going to get closed because it is a huge loophole. I have no idea how it got designed in, and I suspect that they never anticipated that people were going to use it the way they're using it, right? So let me answer a couple of your questions. Your employer has to allow it, and many don't. I'm fortunate. I heard a podcast 3 years ago when this concept was first coming out. I jumped on it because I was like, man, this sounds interesting. So I did some research. I called Vanguard, who's our 401k company, and they said, yeah, your company allows it. So I was like, great, let's do it. It's manual. It's not something you can just click on a computer screen and make it happen. You got to do some phone calls, fill out some forms, but it's well worth it. So yeah, your company does have to offer it. and I cannot answer why it's in the tax code or the 401k code or the way it is now. I don't expect it's going to last. So if it's something that is of interest to your listeners, I would really encourage them to try to max out their contributions for the rest of the year and get a Roth conversion in before December 31st.
Yeah, that's great. And just to be clear, everybody should, if you're interested in that, and certainly this is after tax money. So that $35,000, that's going on your tax return as taxable income, but you're putting it in a Roth. So it's as if you were making a regular contribution to a Roth, which again is normally limited to $5,500, but you're deciding because you have this loophole that you're going to put in $35,000. So it's taxed now, right? And then, down the road, because it's in a Roth, there's no tax implications whatsoever.
That's right. And if you think about the tax logic, and again, this is all part of the withdrawal strategy. Theoretically, you want to have stuff count as income when you're in your lower taxed years. So conceptually, doing it now and when I'm at my peak earning years doesn't really make sense, right? Financially, it's probably not optimized, but to me, the value of having as much Roth as possible in my drawdown strategy is worth taking a potential financial hit to get it set up. That's the thing. You should do a Roth when you're younger in your career and you're not in the higher tax brackets. Max them out, right? Any of your listeners that are making less than 50, 60 grand a year, 100% into Roth. Don't even think about it, because as your income grows, you're into a higher marginal tax bracket. That's when you want to do the before tax contributions and then wait until retirement to pull that money out and have it count as income. That's the traditional way of doing it. But this mega backdoor has so many other attributes that are attractive about it that I'm kind of going against the grain of how you'd normally fund a Roth.
Yeah. So anyone listening to this who's interested, definitely call up your HR department. They might look at you like you have 10 heads, but just, keep asking questions. Do you allow after-tax contributions? And I think there have to be in-service withdrawals is the terminology. But just ask a couple questions. Call your 401k company if you have to, and find out if your company does allow it.
That's it. Yeah.
All right. So Fritz, we started this conversation introducing the concept of having a drawdown strategy and maybe talking a little bit about how to generally approach it. But now we want to take a few minutes and talk specifically about your strategy. And based on my understanding of the article that you wrote on this, the place to start is asset allocation. So why don't you go ahead and just take a few minutes and walk us through your game plan?
Yeah, perfect. And I think the broader discussion of asset allocation is the right place to start. As you get closer to retirement, you don't want to have too much exposure to equities, because if the market collapses, you've still got to pull money out and you can't run that risk. So right now I'm roughly, it's conservative. I'm about 50% stocks, 40% bonds. And then I've got 10%, in some alternatives, other stuff that I trade on the side just for fun. So basically, it's let's call it a 60-40. And basically, I've increased that 40% in bonds and safe stuff as I've gotten closer to retirement. So the first question you have to think about as you're setting yourself up to go from accumulation to decumulation is, do I have too much risk? Do I have the right amount of exposure to equities to continue to keep up with inflation, but the right amount of safe investments to make sure I can pull money out of this thing for the next couple of years, even if there's a market downturn? So that's the first question, is asset allocation in spite of the tax issue. You've got to think about what you've got. Then when you move into the next phase, which is thinking about this tax issue, you've got to make sure that the monies you're going to take first, they're in the right tax structure that you can get at them. For example, if it's in a 401k, you can't get it to your 59.5. Now there's a clause there. You can actually get it at 55. If you retire in the year you're 55, too much detail. The point is, do you have enough after-tax money to be able to bridge yourself over to the point where you can start getting into your retirement accounts? And then once you've identified, yes, I do, you need to make sure that the assets within your after-tax account aren't subject to massive stock volatility, because those are the assets you're going to be pulling first. So they both go together, but it all starts with asset allocation.
I was a little bit interested in the asset allocation you chose because, Brad, I don't know if this struck you, but in my mind, because you have this corporate pension and because you have Social Security as a reality for you, I think that's probably a safe bet at this point. In my mind, I almost feel like you could be more aggressive than you are. And I wonder, does that strike you as well? Or even with the pension kind of being there in place and you know it's going to be there, and the Social Security, the 60-40 still feels right?
You're absolutely right. I've had this discussion with Vanguard. By the way, if Vanguard is your 401k provider, a lot of times they'll give you a 1-hour session with a CPA every year. So I have a 1-hour session with a CPA at Vanguard for free every year, and they always say, well, the last 18 months as I've been pushing more into bonds, you need more exposure to stocks. My answer to that And the retirement answer man, Roger Whitney, he's got a saying, and I'll butcher it, but it's something you don't have to take more risk than you have to take. And we've built a significant net worth such that we don't really have to have, the aggressive growth. We know we're okay. So we're intentionally being a little bit more conservative because we don't have to have the pie continue to grow quite as aggressively. So for peace of mind and everything else, to just be able to automate this and forget about it, we've chosen intentionally to be a little bit more conservative than a lot of the theory would say you should be. So yeah, you're spot on. It could be more aggressive, but it's just a personal comfort level. We don't need that. We don't need that aggressive position. So let's not take it. We're okay.
That is the balance. We talk to people about the idea of don't take more risk than you need to, but also don't be more conservative than you need to. And then I love J.L. Collins' approach to this. You need to pick an asset allocation that allows you to sleep at night. And I love that you've made enough right decisions along the way that you can afford to be more conservative because you have enough. And no matter what happens, hang on, I don't know where that last line is going to go.
You got to keep that in the podcast. That's a classic line. That's great.
Sometimes he leaves outtakes in, so yeah, who knows?
All right, let me try to collect myself. I think what I was going for is, that is peace of mind. Unfortunately, that's not the problem that most of the world faces. They're just trying to get some margin, any margin. They haven't made any right financial decisions. They've made all the wrong choices, and they have no interest in fixing those choices because, frankly, no one has shared with them the idea that there is another way to tackle this journey. But in our community, where we see hundreds and thousands of people pursuing this ultra-optimized path, you can get to the point in time where you don't really need to worry about money anymore relatively quickly. And at that point, I think it's really cool that with you, we get to talk about this idea of when is enough enough? And at what point are you not asking how aggressive do I need to be, but rather how conservative can I afford to be? And I got to say, that's a pretty good place to find yourself.
It is. And I think another way to look at it, you talked about Big Earn earlier. His safe withdrawal rate series is mind blowing, right? It's 15 articles. I mean, it's a doctoral thesis. It's just phenomenal. But just step back for a second. A nice way to measure that is what's your withdrawal rate going to be? If your withdrawal rate is going to be 3% or less, guess what? You don't need to take a lot of risk. You got a bunch of money. You can cover your spending. You're fine. If your withdrawal rate is calculating where it's got to be like, hey, 4 to 5%. Guess what? You better keep a lot of equities going. You better hold off retirement a little bit. You better build that pile. And that withdrawal rate is kind of a nice little thermometer for how sufficient are your savings to cover your living requirements. And the lower that withdrawal rate, in my mind, it kind of correlates to what we're doing in terms of asset allocation, right? We're going to be below 3% withdrawal rate, and we're 60-40. Okay, that kind of fits the way I look at it.
So Fritz, I don't think in today's episode we're going to go into too much depth on your pension, but I do think it's very interesting to note that you made the intentional choice to delay drawing down on your pension, and I would love to hear your thoughts on that.
I think the broader question, and it applies to everybody, it's exactly the same as Social Security. Right? If you delay Social Security, everybody knows, or maybe not, but it's common known thought. If you delay it, it grows 8% a year, right? So delay till you're 70 if you can pull enough cash out of your investments to get you to 70, and it's 8% higher per year. It's the exact same thing with my pension. Every year I delay it, it compounds 6%. So my thought is right now, there's not a lot of investments out there that you can have a guaranteed 6% rate of return. That's worth drawing down some of my investments to bridge myself for this 2-year gap. That's really the concept.
Yeah, Fritz, nice pivot on that one. I love that. Well said. And it illustrates to me yet another topic that we really need to dive into on this show.
And I think everything that you look at should be kind of opportunity cost. If you can delay Social Security and earn 8%, what's your opportunity cost? If you take Social Security early, are your investments going to earn 8%? Maybe. Maybe they'll earn 12, but maybe they won't. That 8% is a guaranteed lock. That's like a treasury bill, right? When you can get a guaranteed high return, look at the opportunity cost if you don't exercise that option. That's really the way you have to think about those decisions.
Yeah, that's the best mental framework I've ever heard for that decision. I think that literally just changed the way I look at it. So thank you, Fritz. That's incredibly powerful. And I'm curious though, so you said this 2 years that you're deferring. Are you able to potentially defer it more than that, or is 2 years the sweet spot?
Well, the way our pension's set up is it optimizes at 35 years. So I'm intentionally just deferring it to that. You can defer it longer than that, but you don't get the 6%. So at that point, the opportunity cost is, hey, I'm only going to get 2%, 3%. You know what? I'll go ahead and just start the thing. I can make 2 or 3% with my money and just go ahead and take the pension. So it's that same logic that's making the decision. it's the opportunity cost of how much will that pension grow versus what I could do with the money if I don't exercise the pension.
Now, the second piece of this is implementing your bucket strategy. And I know that it's very helpful to use actual numbers. Brad, did you want to try to set up a case study?
All right, Fritz. So somebody is going to retire. Let's say they're 55, like you. They've been diligently saving, and they have money in a bunch of different buckets, as we call them, which they have a bunch in their 401k, maybe a traditional IRA, a Roth IRA, and also then just regular savings, right? Taxable investments, as we call them. So let's even just argue they have a significant amount of money in each. If they're retiring early, then presumably their net worth is $1 million plus. So a couple $100,000 in taxable investments and the rest spread across 401k and Roth, et cetera.
Yep.
So they're getting ready to retire. And like, this is what I want to hear about, the actual drawdown strategy. So they pull the retirement trigger. Their income is now zero. So they have a lot of taxable space to play with to potentially have taxable events, but ultimately pay $0 in tax. But what does this look like for them in the first couple of years, the intermediate term? Like, how would you counsel someone who's facing that situation, who's getting ready to retire? How would you counsel that they move forward?
Yeah, that's a good question. And it really gets into the tactics of how you structure these buckets. And if you think about bucket one being cash you need to spend in the next 1 to, let's say, 3 years, you've got to have 3 years worth of spending. Clearly, that's got to be after tax, right? Because you're going to spend it. It's got to be liquid. It's going to be safe. It's going to be the Capital One stuff. So you structure bucket one with all after tax. And then what we've done, I mentioned where we've got our net worth statement and we've linked each one of the accounts into one of the buckets. If you look at the IRA as an example, where you have forced, RMDs when you're age 70 and a half, well, guess what? That's 15 years out. Okay, fine. I'll put that in bucket three. So I've got an intentional line in bucket three. That's my IRA before tax. And guess what? It's invested in equities, right? So you do have to take the tax structure into account when you place those specific monies into each bucket. And then as you go through time, and you're rolling stuff from bucket three to bucket two to bucket one, well, that might be where you take an IRA distribution, you pay the tax on it, and you've moved it into bucket two and you put it in bonds or someplace safe to kind of stage it for when you're ready to use it in bucket one. That's the way that we've set it up.
So in bucket one, do you always have 3 to 5 years of liquid expenses, like on a rolling basis, essentially? Like you're constantly refilling it? Is that how you're mechanically doing this?
Yes. And the only exception to that would be if you get into a bear market. Again, we've got a pretty healthy bond portfolio, so I'm hoping we can continue to kind of keep it at the 3-year level. But if you would get into a bear market, that's why you've got 3 years in that bucket one. The concept is you could theoretically pull that down to maybe 6 months. Just keep spending, and don't sell anything in the equity side until the equity markets have a chance to rebound. And then, it's just a question of how much risk you're willing to take. Theoretically, you could put, 5 years, 10 years in bucket one and mitigate any risk of sequencer return risk when the stock market is down and you need to sell stocks. The problem with that, obviously, is you're foregoing any kind of investment return when it's in bucket one. So there's a balancing act between the two. But the concept is have enough in there to buffer you against stock market volatility.
Okay, so that makes sense. So I guess in my hypothetical, we're saying we've used $60,000 of yearly expenses. They have 3 years worth in their liquid accounts. So they're going to use those funds to basically fund their lifestyle for the next couple of years. And it's just going to come out, like you said, of your Capital One account and all is well in the world. But they still have some space, right, to harvest capital gains. So presumably they can expose themselves to some taxable income, to some taxable events where they sell some of their appreciated stocks or mutual funds and create that taxable gain. But ultimately, it's $0 in tax because they have this space. But how do you advise people go about that? What types of buckets are we looking at? And how does that work in your estimation?
Yeah, no, that's a valid point. And it's not unlike what we're going to be doing in the first couple of years when I do these Roth conversions, right? We're intentionally creating a taxable event by selling our pre-tax IRA because we know we don't have any income. Well, you can continue that through life, right? As you look any given year, well, just look at how much more income can you generate or capital gains, and look at the tax brackets and continually to top off that tax bracket by generating a taxable event that keeps you just below that next tax hurdle. And that's something that it works, I think, in parallel with the buckets because you can choose at any given point in time what to sell and which buckets to refill. Well, fine. If you want to sell some before tax IRA stuff and the stock market's gone crazy. Well, fine, you sell $20,000, $30,000 of that. It creates a taxable event. It pushes you, you get $20,000 or $30,000 of income now, right? So you manage that. And guess what? You've just moved that from bucket 3, depending what you buy back with those after-tax monies now. You can either keep it in bucket 3 and just invest it all in stocks, or you can move it to a more conservative investment and start refilling the buckets that are upstream. So you can marry the two concepts, and you should, because that's how you minimize your tax over the course of your retirement.
Or a third option is you could buy something different.
Yeah, absolutely. And if you look at, I'm in international stocks have done great. So I'm going to sell at the peak. And what I'm most likely going to do is I'm going to look around for something that's been a laggard. Maybe it's, gold or something, right? So you can move it into any other asset allocation you want based on what the markets are doing. Or you may just decide I'm going to keep it in international stock because it's a long-term play and I'm comfortable that they'll be good over the course of my life. So yeah, absolutely. You can use that as a tool to adjust your asset allocation.
The third piece to this general way of approaching it was how to figure out health insurance. And I'm just interested in how bleak it really is, because you're retiring at 55 and Medicare is going to kick in at 65. And it sounds like you're going for more of a fat fire retirement where it's going to be probably at a higher income level. You might not qualify for subsidies. What does healthcare look like in that gap where you're paying the full brunt without any subsidy help?
Yeah, that of all the issues right now that we're dealing with, that's probably the one that I'm an optimistic guy. Things will sort out. At the end of the day, it's just money, right? But it is a big issue, and it's so uncertain right now that it's a huge question mark. And you're trying to lay out how much am I going to have to spend every year? Heck, I don't know. So I've done some research, and we're planning $24,000 a year, $2,000 a month just for our insurance coverage, and that's probably low, right? And our feeling is, as long as we've bucketed in enough cash to cover what we think is a reasonable expense, and the numbers still say we can retire, then fine, we'll retire and we'll figure it out. But it's a big issue. And what we're going to do, we're going to pay for the COBRA coverage through my employer for 18 months. The logic being, number one, the group rate is based on, from my understanding, kind of the average population in the employer's pool. So let's say the average age is 40. I'm paying the insurance rate that a 40-year-old would pay. Whereas if I go out and buy it on the private market, guess what? I got to pay what a 55-year-old's going to pay. So I'm going to take my COBRA, hoping that it's slightly lower rates. I'm not even going to shop it. I'm just going to go with COBRA. It's easy. It's done. And hopefully over that 18 months, the market's kind of sorted itself out. And, so I've got, a couple of years here. I'm really hoping it settles down, but it's a big issue. And what I've started doing, I'm going to write a post about this. I've started a spreadsheet, Google Docs, on every other blogger that I've seen that's written articles about what they're doing for health insurance in early retirement. And I'm keeping all those, and I'm kind of building my data right now on what the options are and what other people are deciding, and we'll make our decision based on that.
Yeah, so depressing. Now, the other thing that's very interesting is this idea of setting up your paycheck, because your paycheck is going to be changing. You're no longer going to be getting W-2 income coming in on a biweekly or once a month basis. Instead, you are going to have to determine how to pay yourself from your savings. And I'm curious about your approach to that.
This took me quite a bit of time to figure this out, and I'm pleased with the way it came out. What we've decided to do, we've opened a Capital One account. And we're going to put it, in Capital One, you can segregate your accounts into different buckets, right? So we're going to have a bucket for major repairs. And, look at major repairs. You got to replace a roof every 5 years, 10 years, whatever it is. You got to buy a car every 5 years, 10 years, whatever it is. Well, you can put all that together. And in our case, it's about $1,000 a month of those kind of one-off expenses that are going to happen over a decade. So guess what? We're going to have $12,000 or $36,000 sitting in one of those Capital One buckets that'll be available to kind of cover those one-off expenses. That's an important piece of it. The part that I'm really excited to implement is the other part of it then is we've got a Capital One bucket that we're going to start on January 1st with what we think our year's spending is going to be. And to make the math easy, let's say it's $5,000 a month. You do $60,000 a year. So what we're going to do is twice a month, we'll start out with $60,000. And then every other week or twice a month, we'll just transfer over that 2 weeks worth of spending from Capital One into our checking account. So we don't have to do anything. We just spend what's in our checking account, just like a paycheck. If there's money in there, you can spend it. And then the beauty of it, we don't have to track our spending. At the end of the year, as long as you only move money from Capital One into your checking account, you look at your starting balance, you look at your ending balance, boom, you got your annual spending. It's a really easy way to know how much you're spending without having to do much work. And it keeps you from overspending because you can only spend what's in your checking account. Now, if the roof goes out, okay, fine. That's why you have that $12,000 sitting over there. You funnel some of that over, and that you just track that balance beginning of year, end of year, and you know how much you spent on maintenance. So it's a pretty simple way, and I think it's going to work.
Yeah, I like that mental appropriation of your cash. So I definitely get that on a conceptual level. We talked about opportunity cost before, though, Fritz. And to me, it strikes me that you're going to have maybe 1 to 3 years worth of these extraordinary expenses plus a year's worth of your normal yearly expenses just sitting there in an account making 1%. Like,
yep.
Was there any consideration as to doing that differently?
To me, the trade-off of liquidity and safety was worth a little bit of a loss. Now, what I'm doing, that's like a year, maybe 18 months worth of cash is going to be sitting in the Capital One. Any other liquid funds that we want to have, but they can earn a little bit more money. I'm a big fan of munis. I'm in a high tax bracket, so muni bonds, it's tax-free income. We've got a bunch of money sitting in muni bonds and some other bond funds. You got some risk there if the interest rates go up. Okay, that's fine. And we're earning probably 2.5%, and that's on an after-tax basis, right? So it's really like a 4% tax comparable return. So there are things you can do. That's why my bond piece is 40%, because we've been really taking advantage of the bond ETFs, mutual funds, treasuries to try to get a little bit better return, but maintain that safety of the liquidity that you need for, retirement funding for the first couple of years.
And just to follow up on that, so talk me through what happens with that Capital One account in year 2. So presumably at some point you're going to need to refill this account.
Yep.
Like, do you sell an entire year's worth of expenses in equities or bonds or whatever it is all in one fell swoop, or what do you have planned for that?
Okay, so that's the other piece of it that I didn't get into. Thanks for the question. As I mentioned, you can segregate your accounts in Capital One. So we've got the one that goes to maintenance issues. We've got the one that covers year 1 of spending. We've got another bucket that's like years 2 to 3 of spending, and that dollar amount will kind of float around. It doesn't. That's not as important as the year 1 of spending. Okay, this is how much I'm going to spend this year. But you have to have a place to put monies through the course of the year to start refilling that bucket 1, right? So we've done that in Capital One, segregated account. And what we'll do is throughout the year, we're not going to do it all at once because you can't time the markets, right? So maybe every couple months, once a quarter, we'll sell a couple months worth of living expenses out of, let's say, bonds. We'll sell a bond fund and we'll dump it into that segregated Capital One account that's set up for years 2 and 3. We don't want to get too much in there because, as you said, you don't make any interest on it. But we also want to have a mechanism to consistently move money into that bucket 1 over the course of each year. And that'll be an ongoing process.
That's awesome. I love that. That's exactly how I would have done it. So yeah, that's cool.
Cool.
All right, so you come to the end of the year and you find out, yay, I spent what I was expecting to spend. We didn't spend what wasn't in the account. So thumbs up. Any other kind of annual task that you do with a year in review?
Yeah, I think obviously update your net worth. That's critical. And look at your asset allocation as you're spending money out of cash. And, if you're not selling any equities, your equity portion will tend to grow. So, there'll be some rebalancing. I do that at the same time we do our net worth. And then the other piece is obviously, let's use our $60,000 example. If we spent 55, great, you got $5,000 in there. We sit down, we kind of do our planning for the next year, say, hey, you know what, let's keep it at 60. I think that worked out pretty well. Well, then we'll transfer 55,000 over from bucket 2, this other Capital One piece, over again to that 1-year spending account, and we'll top it off right up to $60,000 again on January 1st, and that's our starting balance that we compare with the December 31st number, and we can see next year how much we spent that year. So those are the 3 main things that I think we'll do every year end.
Now, this is one thing that's a little bit interesting to me, and I'm going to throw you a little bit of a curveball here, is just that typically when we talk about a safe withdrawal rate, and I'm specifically referring to Big Earn because he reminded me about this, but when we talk about the 4% rule or the 3% rule, those are adjusted for inflation. So I'm just wondering, as you're approaching this, how are you building inflation into your cost of living? And specifically, how are you building that into your plan with the 55,000 versus the 60 versus, that ever increasing number potentially?
Yeah, that's a good question. And, I'm a big fan of kind of this, if you look at Michael Kitces, he's got all these different theories. You can do a straight 4% withdrawal and adjust every year for inflation. I tend to like better this somewhat variable approach where you kind of got a floor and a ceiling, and based on how well the markets are doing, you had a great year, everything's up, great. You can go ahead and go up as much as inflation goes up, or maybe even a little bit more. But if the markets had a terrible year, you know what, we're going to freeze our spending at last year's level, and we'll just absorb the inflation by spending a little bit less, right? So I think you've got to be flexible. And the other thing is your personal rate of inflation isn't going to be the same as the consumer price index, right? We got our house, it's paid for. The only inflation there is taxes, right? So I think you do have to look at what your personal spending rate is. And hopefully, if your housing's paid for, your cars are paid for, things like that, I'm hoping that our personal rate of inflation should be a little bit lower than the economy as a whole.
Yeah, that's absolutely perfect. And I think if we know that the 4% rule or the 3% rule has inflation built into it, yet you, as you were just pointing out, your personal rate of inflation isn't tracking that same index, then that almost builds in some additional buffer for you into these numbers.
Yeah, now you could argue it could be worse, right? Because if you look at what percent of your spending is healthcare, and is healthcare potentially going to be higher than the CPI? Yeah, of course it probably is. So it could go either way. I think you just have to be cognizant of it and adjust for it, each year as you put your spending plans together for the following year.
Well, we're optimists. I'm sure they're going to get all the healthcare problems fixed within the next 12 months.
I hope you're right.
All right. So let's take a second and talk a little bit more about long-term strategy. So we mentioned in passing the value of delaying Social Security when you're able and viewing it as the opportunity cost for grabbing it early. I noticed that one of the things that you talk about in your article series is the value of protecting the Roth. Do you want to explain that idea a little bit more?
Sure. If you've got an asset that can generate tax-free return forever, it should absolutely be the last thing you take because it's growing tax-free. So anything that's not growing tax-free, you should pull down first. So our plan right now is when I'm 85 years old, God willing, all we have left is a Roth, and then I'll spend down from the Roth. But we're going to try to not touch the Roth and keep it invested in pretty aggressive stuff so that it can continue to grow tax-free.
So practically speaking, if the Roth is the last thing that you draw down on and there aren't any required minimum distributions, the natural implications of that is that the Roth is what would be left for your heirs. That would be your legacy. And I know you have a daughter. Have you thought about the implications of that being what's left over?
Yeah, I think I look at that two ways. I think number one, it's a longevity risk play, right? If we do live to 100, you've got to have some money there. So you kind of have to plan for a long life. And then if you don't, live that long, okay, fine, our daughter, we told her she's not getting anything, don't plan on it, we're going to spend it all in retirement. You don't want her to think there's a nest egg coming. But in reality, if we die younger than, I think we've cash flowed out like 95, it's kind of, we both die at 95 and we're fine. So there's realistically going to be some money left. And I've not gotten into the tax treatment. I think there are forced distributions once she takes it, but I'm not sure how the tax works on that if it's inherited. I'm not sure. I should check into that. But you know what? She'll be happy. She'll get some money. If she has to pay taxes, she has to pay taxes.
Well, we'll try not to let her find out about this podcast so that you can let the secret ride a little bit longer.
All right.
All right, Fritz. The next thing that we want to talk about today is life insurance.
Yeah, what we did with life insurance, this was kind of interesting. We have life insurance through my employer, but obviously when I retire, I won't get that anymore. So I did buy a separate policy, 20-year fixed term, so it'll go until I'm 70. And my thought process on that was, if I pass away, you've got different survival clauses on your pension, but the one we're going to probably choose is where my wife would get 2/3 of the value. So our thought on that is we'll supplement what she'd get in the pension by a life insurance policy. By the time I'm 70, it doesn't really matter at that point because, the investments would have done well and she can get by on 2/3 of the pension. So we did that in case I would die early and she has to go, 30 years with a reduced pension. She'd have a little life insurance kicker to help her out. That was the logic there.
All right. And then another one that I know that you mentioned that I think is very reasonable for people to consider post-retirement is this idea of part-time work.
Yeah, it's huge. I mean, if you look at the numbers, so where we're at on that, we intentionally are not going to retire until we, based on all of our predictions, we'll never have to work another day in our lives for money, right? That's the first premise. Once we get to retirement, we may well choose to work just for the fun of working, right? The social interactions, whatever you get out of it. So what we're thinking right now is we'll have our fifth wheel. Maybe we'll go out to Yellowstone and we'll work a seasonal job for the summer. Maybe we'll go pack boxes for Amazon for the Christmas rush. Maybe we'll do a couple things like that. They're not in any of our numbers, so that's a little bit of a buffer again. We will probably do it just because it sounds kind of fun, but the financial consideration isn't the reason we're doing it. So it'll all be gravy.
I love if you tie that back to what J.L. Collins said on our show. He said, I may end up working again, but it won't be for money. Money will no longer be the primary motivator.
Exactly. And think about that, right? If you can do something just because you want to do it and it's not driven by the need for the cash, how much more interesting would that job be, right? You're just doing it because you know you want to do it. And if you want to quit, you can quit. I mean, it adds so much freedom. That's what FI is all about, right? It's independence to do what you want to do and not be dependent on the dollar. So it changes a lot of things in life.
Yeah, and that's just accumulating these different life experiences, right? And just to have the flexibility and the options to do that. Sure, some of them might make money, some of them might not. But like you said, like packing for the Amazon Christmas rush, like what a cool idea. Like something like that, who would ever think to do that just as like a fun adventure in retirement? But you did, right? And that might be something interesting.
Yeah, and maybe you go in, it's a total bust. You're like, man, my back's killing me. This is really, this is hard work, right? Maybe it's a bust. Okay, fine, you don't do it the next year. But maybe it's, hey, this is great. I'm in here with a bunch of other early retirees. We're having a great time. We go out and have dinner together afterwards. You make friendships. Who knows, right? But you're free to explore. And that goes back to what we said earlier about having that mindset of curiosity and that mindset of always learning. Well, heck, I'm curious. What's it like to work for Amazon for the Christmas rush, right? That all stems from that same mindset of being curious and wanting to explore things as you go through life.
Does any type of world travel factor into your, this open mindset? Like A, just for the mindset purposes, and B, we talked about healthcare and how expensive that is. It's dramatically less expensive in other parts of the world. Like, has that ever factored into your consideration?
Well, I mean, I've traveled my whole life. I'm going to Bahrain in a couple of weeks, and I've traveled. I got tons of miles, so I'm million miler on Delta, so I got all kinds of frequent flyer miles. So we'll definitely have some international travel. We're looking at maybe doing some slow travel where maybe you go rent a house in New Zealand for a month, and you just kind of stay put and you do some little side trips. The problem is we got 4 dogs. We love our dogs. I remember one of you guys have a couple dogs too, so we're dog people, and those are important in our life. So it's going to hamper how much of that we can really do, but we'll definitely weave in some international trips here and there where possible. Maybe our daughter will take the dogs for a month and we'll do something like that. I don't think we would do I don't know if you call it geo arbitrage or what you'd call it for medical insurance. I think we'd rather just make sure we've got enough money set aside to be able to deal with it here. I know it's cheaper, but that just makes me a little nervous,
Fascinating. I'm the dog person, so my kind of people for sure.
Okay, there you go.
So Fritz, the last thing that we wanted to cover before we let you go was the topic of long-term care insurance. I've heard in the past that is a critical part of financial planning, especially when you're approaching your 60s. And I know that's on your radar. I know you just recently wrote an article on it, but it's pretty expensive, right? I mean, heck, Fritz, we heard you just a few minutes ago talking about how expensive just healthcare could be if you're in this place where you have a very high income and you're paying for it all out of pocket. I mean, you were budgeting $20,000 to $24,000. And then on top of that, from everything that I've seen, long-term care insurance could be equally as expensive. And I'm very curious, what did your research tell you about this, and what did you end up deciding to do about the problem of long-term care?
Yeah, that's a big issue for everybody as well. I just wrote an article 2 weeks ago, so anybody can look it up on my site. But basically, where we came down on it is 5-10 years ago, it probably would have been worth doing. The rates were reasonable. Now, obviously, they were too low, and 90% of the insurers have left the market, so that tells you something. And the 10% that are left have absolutely jacked their rates. So what we did, and that's what this article is about, is I basically compared, again, it goes to that opportunity cost mindset. I basically built 2 columns in a spreadsheet. One was our annual premiums if we buy long-term care. And it was something like, don't hold me to the numbers, $3,000 to $4,000 a year. Let's say $3,000. So we put $3,000 in column A, and that's how much I'm spending every year for the insurance. Column B, I would invest that $3,000 and it would earn, I think I used a 4% conservative assumption, and we just let it grow. And every year we'd put the insurance premium back into this other investment, and we would continue to fund it to the same amount that we would have been spending on the long-term care insurance, if that makes sense. And then we just compared the two. Obviously, if you go into long-term care in year 1, shame on us, we should have bought the policy, right? Because you got 3 years worth of coverage and you've only got $3,000 saved. You could never cover 3 years of insurance. What we found was that in our case, at about age 80 to 85, we'd have about 3 years worth of long-term care built up in this investment pool. So we're kind of self-insured, and our break-even point was in our mid 80s. And ironically, that's when the statistics say you're most likely to require long-term care. So we said, you know what, we'll just self-insure it. And then if we don't need it, that's just more that goes into, the fund money or gets passed on to our daughter.
Yeah, that's fascinating. And that, in my mind, is consistently the way that the FI community tackles problems like this. It's just math. And There's certainly an emotional component to it when you start talking about the concept of long-term care, but I think this is a very reasonable way to approach the problem. And I think there's 2 points that our audience should latch onto, and we're going to link to this article in the show notes. One is how to do that calculation, how to find that break-even point, and then also maybe go check out that study that you talked about by Elder Law that showed the statistics of where the average individual ended up needing those. I think that's useful information. And the second part of that is if you end up taking the choice that you're making, which is to self-insure, and you just set aside that premium, go get a quote, find out how much that premium is going to be, and then set that amount aside, continue to invest that aggressively for that period of time. If you end up needing the money, you'll have it based on the math that Fritz just did. But then if you don't need it, that's a significant extra lump sum that you have available. And you found that by the age of 90, you would have an extra $1.5 million.
Yeah, it's material. And if you would have bought long-term care and paid those premiums all those years, that would have been $1.5 million worth of net worth that you destroyed because you didn't need the policy, but you spent all the money on it. So you kind of get the best of both worlds. You've got enough money there to cover the need if you have it, and you've got the investments if you don't need it. So to me, it was just a no-brainer decision. There's obviously risk, right? Because if we end up needing it for 5 years, we run out of money, okay, we'll deal with it. But there's no easy answer to the long-term care dilemma. And it's kind of like the health insurance. That's why people are worried about it, because it's an unknown, and it will be until you're 85 years old.
All right, Fritz. Well, this has been amazing at every level. I think this was the perfect end cap to everything that we've been talking about, starting really back at the beginning with the pillars of FI, and then going to J.L. Collins, talking about the simple path to wealth, and then talking about the dark side with sequence of returns with Big Earn. But then once you get past all that, you have to talk about drawdown strategy, and you crushed it. So thank you so much for coming on the show.
Hey, it was my honor, guys. I really enjoyed it, and I love your show, and I'm glad that we were able to put some content out there that hopefully can help people achieve a great retirement, right? That's what we're all about. So
now, normally we would let you just go, but on this show, we're going to give you a chance to tackle the hot seat. Are you ready for this?
I love fire. Bring it on.
Okay.
In a world drowning in debt and rampant consumption, trapped by the chains of lifestyle inflation, these questions highlight the secrets of those who have broken free. Welcome to the Choose FI Hot Seat.
All right, Fritz, question number 1, your favorite blog that's not your own.
Oh boy, that I tell you what, I read so many blogs. We talked about having that curious mind, and I've just there's so much good content out there. But if I had to pick just one, I've got to reach out to my friend the Groovies, because I don't think they've been picked by anybody. Freedom is Groovy is an awesome couple. They speak with a very unique voice. He writes and she writes, and they did this awesome geo arbitrage move from New York City down to the Carolinas. And they've retired early, and they're personal friends of mine. They were the first bloggers that I connected up with, and we've had a lot of phone calls. I'm talking with them tomorrow night, as a matter of fact. Definitely a great blog. You should check it out.
I think I saw you guys talking trash on the side of the road recently.
Hey, you pay attention. Yes, we actually did he does these trash talking videos, and they're hilarious. And he just goes off on these random rants, and I was able to be his first guest host on his trash talk. So yeah, that was fun.
It was remarkably soothing.
You weren't the one picking up that crap. That was nasty.
All right. Follow-up question. What do you think we should talk to them about when we bring them on the show?
I would say the geo arbitrage and kind of how they leverage that. That's a really good FI tool. A lot of people talk about it, but I don't know how many people have actually done it. They've done it successfully, and they retired early. So I think probably the use of geo arbitrage as an FI tool.
All right. Question number 2, your favorite article of all time. Now, this can be one that you wrote or somebody else's.
Yeah, I think if I think about to me, that's what is cornerstone content in the FI community. And to me, there's no comparison to J.L. Collins. I mean, he's such a legend, and his stock series is it's phenomenal. And maybe I would put in there now Big Earn and his 15-20 part withdrawal strategy. That's classic cornerstone content. So I would say the two of those are probably the best content that I've seen. All
right, Fritz, question number 3, your favorite life hack.
Yeah, I think in our case, we talked about it a bit during the podcast, but we downsized. We sold our big city house, we bought our mountain cabin, and we didn't get into this, but we actually did it a second time. And as we speak, our first cabin, we have an offer on it. We're supposed to close in October. and that appreciated quite a bit. So we sold it as appreciated, and we bought a lower price cabin just as nice, but had some features we liked. So we've kind of done two of these downsizing to generate liquidity out of your home equity to use for retirement. So downsizing to free up money for fire.
All right, question number 4, your biggest financial mistake.
Yeah, this is we've all got our stories, I guess. I'll tell you what comes to mind for me is I got a little bit of inheritance from my grandmother, not a lot, but it was kind of the first time I really had free money that I could just speculate with, right? So I opened up my TD Ameritrade account. I was all excited. This was right during the tech boom in the late 90s. And there was a company that I was using at work, and actually some of the people from my company left and went to work for this company. And everybody's like, these guys are going to the moon. They're great. So I threw a bunch of money into their stock, and it absolutely cratered during the tech collapse. Fortunately, it was early enough in my career. I didn't have that much money in there, but still, from a percent loss, I think I lost, 98% of the investment in 18 months. It was absolutely brutal. Good lesson learned, manage your position sizes, diversify, and understand what you're investing in before you invest in it. That was a painful lesson, but it's a good one. I'm glad I learned it when I did.
I felt like he was going to finish that sentence with Enron. I don't know.
WorldCom, Enron.
Yep. I was like, here it comes. Here it comes. All right. Question number 5, the advice you would give to your younger self.
Yeah, this is timely. My daughter's 22, so I look at her and I think of my life at that stage. I actually wrote an article to her, the first 6 steps to financial wealth. And if I think about probably the first step that I mentioned to her was realizing the value of time and how powerful that compounding is. When I first started in the working place, I think I was contributing like 6% to my 401k. Don't give up the employer match, right? But I didn't really know what I was doing. And I probably dribbled around 6 to 7 to 8% for the first 5 years of my career. Now I'm saving, close to 50%. I wish back then I would have been saving 15, 20% earlier. Now I'm fine. We're getting out early, but compound that over 30 years. And we probably could have gotten out a couple of years ago just on that one move and that one move alone. So start early and start big. And that's what I'm telling my daughter.
Yeah, that is wonderful, wonderful advice. And yeah, I have young daughters now, and I'm trying to come up with a plan for how to introduce this to them when it's a little more appropriate. So yeah, I'm going to check out that article for sure.
Oh, and I'll tell you, it's challenging, right? Because we're passionate about this. Obviously, you guys do a podcast, I do a blog. Our kids tend not to be, right? They're more like society as a whole. So it's hard to find ways to introduce them to it without them just saying, oh yeah, this is Dad talking about that finance stuff again. You've got to find a creative way to make it real to them. And it's a challenge, and it's been a challenge since she was 5 years old. It's a challenge when she's 22. It's raising kids is a challenge, but it's rewarding as all heck, and it's great. But just be realistic in your expectations. They don't care about this stuff as much as you wish they did.
Yeah, I like that. Be realistic. I will definitely remember that. So, all right, we have one last bonus question for you. What's the favorite purchase that you've made on Amazon.com in the last year?
Well, this was actually on B&H photo thing, and a buddy of mine gave me a heads up and said, "Man, this thing just came on sale. It's a great deal." It was a bunch of money for the FI community. It cost me about $500, but I am so ecstatic about it. I finally bought a drone, and I bought it because I want to develop the photography and video and all that into retirement. So this is positioning myself to develop an artistic side in retirement, and I love my new drone. It's a blast to fly around, and I haven't crashed it, and it's the best thing I've ever bought. It's fantastic. So get yourself a drone. They're a lot of fun.
Techies unite.
Indeed. They're amazing. They're a lot of fun.
The guy that's doing the documentary, Scott Rickens, doing the Playing with Fire documentary.
Yeah.
That is his signature move. That was his kind of claim to fame in this space was drone operations. So it really is. It really is a whole new industry for people that know how to do photography and camera, and they can merge that skill set with drone piloting. I don't know.
Exactly. And then you think about our space, FI and social media. Well, then you set up a YouTube channel and you can do some really cool editing. And, now you're traveling around in retirement. Well, guess what? You do a drone shot of Yellowstone National Park and you edit it all together and you do some still shots. I mean, it feeds so well into what we do anyway. It's really a great hobby. So I'm excited about it.
All right, Fritz, thank you so much for coming on the podcast and sharing your time today. This information, this is like the perfect end cap to everything that we've been talking about up to this point. And I know this really doesn't even touch all the content that you've been creating over the last several years. So I'm sure our audience, many of them were already familiar with you, but I'm sure there's a pretty large segment of people that this is the first time they're hearing about Retirement Manifesto. What's the best way for them to connect with you and connect with the work that you've been doing over the last couple of years?
Yeah, thanks for that opportunity. All my stuff really is based on my website, which is theretirementmanifesto.com, one word. And I've got probably the easiest way for people. I've got an about page. It talks all about me. And then I've got every article I've ever written chronologically outlined there. I've got stuff sorted by topics, so you can reach me there. You can reach me on Twitter at Retirement Manifesto. Those are probably the two biggest forums that I'm on. And people want to sign up for my email. I have a free net worth template that they can download onto their computer. And if you're not tracking your net worth yet, please use this form and start tracking your net worth. And, give me a note. Let me know that you found me through Choose FI. And, I'll reach out to you and say, thanks for taking a look at my site. I appreciate it.
And also, guys, I know that Fritz is also in our Facebook group, so I'm sure you can reach him there as well. So what I love about Fritz is just how willing he is to give of his time and answer your questions directly. And just a very, very generous guy, highly respected in the community. So we're just very grateful that he was willing to come on the show today. And we absolutely hope that you will reach out. Definitely check out his net worth template. I've downloaded myself. It's a very useful tracking tool. So definitely reach out to him. Let him know that you got value from the show today. And thank you for being a part of the Choose FI community. If you want to support us, here are 4 easy ways. 1, leave us an iTunes review. If you want to do that, just go to choosefi.com/iTunes. 2, use our page to sign up for travel credit cards. If you want to travel the world with miles and points instead of your hard-earned dollars, then just go to choosefi.com/cards and get started today. 3, if you're working on the milestones of FI, set up a personal capital account to track your progress and use our affiliate link. It's completely free, and just go to choosefi.com/PC. P as in Paul, C as in cat. And 4, and most importantly, find your friends, coworkers, and family members who might be open to this message and tell them about the podcast. Have them start with episode 38, The Why of FI, and right behind that, have them go listen to episode 21, The Pillars of FI. It is a fantastic starting place. All right, my friends, the fire is spreading. We'll see you next time as we continue to go down the road less traveled.
You've been listening to Choose FI Radio Podcast, where we help middle-class America build wealth, one life hack at a time.